The U.S. job economy, job market seems to be doing just fine. America added 130,000 jobs in January, and unemployment dropped to 4.3%. Let's get more on this from Gennadiy Goldberg, head of U.S. rate strategy at TD Securities. Gennadiy, always great to see you. What jumped out for you with this jobs report?
Well, it's really the unemployment rate, to be quite honest with you. I mean, the job numbers themselves were certainly quite strong. We had some upside surprises, definitely not enough negatives to go around. But that drop in the unemployment rate to 4.3, which is roughly the Fed's estimate of NAIRU, the basically kind of the steady unemployment rate, that's going to give people pause. That's going to really tell the Fed they're not in a huge rush. They don't necessarily have to go in the very short term.
That's interesting. I mean, it's only 1 month. Is there any indication as to why U.S. employers are feeling optimistic and they're hiring?
Well, if you dig down into the jobs data itself, we did see some pretty serious gains in healthcare and education. And that's been a category that's been driving a lot of the job gains. This time around, it drove more than 70 or 80% of the total increase in employment on a month-to-month basis. So the sectors are definitely more concentrated. It's not really a broad-based recovery. And as you mentioned, this is 1 month. I think what it does is really take the heat off the Fed to go necessarily at the March meeting. But they're going to keep watching. This is not over yet. They know that the labor market is going to be quite jumpy on a month-to-month basis. What they really look at are trends. They tend to look at 3-month trends, 6-month trends. This is just one data point to them. But I think for markets, this really helps the markets lower the pricing for March and potentially even April rate cut pricing.
Maybe we could put up a 1-year chart for the U.S. dollar. Now, we did see U.S. bond yields rising, people selling bonds today. They often do that when they see borrowing costs stay stable. And I know the Fed doesn't influence bond yields directly, but it looks like this is causing ripples in the longer-term debt market.
Yeah, and what this really does is kind of influence the very front end of the curve. We did see a sell-off. It was actually a curve flattening. So the front end actually sold off more than the long end. For me, this is just a function of the market pushing off the first rate cut, modestly increasing the Fed's terminal rate pricing. So, for example, where they expect the Fed to really end the cutting cycle, that's gone down into the low 3s before this print, and it's popped up a little bit after that. So what this really means to me is a little bit more patience for the Fed, not necessarily, a Fed in a rush to cut interest rates. And it really complicates the job for, incoming Fed Chair Warsh as well, who's, has been appointed with the promise of additional rate cuts.
That's interesting. Sorry, what does it mean for Kevin Warsh? Give us that again.
Yeah, what it means is Kevin Warsh is going to really have a bit of an uphill battle, potentially, convincing the rest of the committee that additional rate cuts are necessary. We've seen in the last month or two, the committee just become much more cautious as we get closer to their estimates of where neutral is. They see neutral somewhere in the range of about 275 to basically 375, with the core of the committee somewhere between 3 and 3.25. Now, as we get closer to that, the debates just get more and more intense. Kevin Warsh is going to have to go really out of his way to convince the rest of the committee that they must cut rates immediately, that they must cut rates rather quickly. It's going to be tough for him to convince the committee if you continue to see labor markets behaving the way they are and inflation the way it is. Something's going to have to change. So I don't think by any means anything is over. We're going to keep watching every single month payroll numbers. But for now, at least, I think it's a bit of an all clear for the Fed to stay on hold.
Would you be a buyer of U.S. 10-year bonds right now? Say your horizon was 5 years and you were looking for a capital gain. I mean, in other words, do you see the U.S. 10-year yield coming down or going up over the next 5 years? I know it's a very simplistic question.
No, and it's actually a really great one. What we've seen recently is a big rise in the term premium. So this is kind of the estimated premium that an investor gets for holding longer dated interest rates.
Gennadiy, kind of a risk premium.
Exactly. Right. It's a bit of a risk premium. So effectively, I think this is actually quite attractive at the moment for 10-year Treasury yields. That premium, according to the New York Fed's ACM model, is about 80 basis points. I think over a longer horizon, that's actually quite attractive for investors. I think around 410 to 430 on 10-year rates is an attractive entry level for the longer term. I think for investors who are worried about the short term, and I think that's what's keeping a lot of folks away, there is a little bit of worry that we can shop around in that range, or potentially, yields could move a little bit higher short term. But I think for the next couple of years at least, these are going to be fairly attractive points to enter. The issue is, again, investors are worried about some of the short-term risks to economic data, the Fed independence, and all sorts of things.
Just finally, there was a revision to the U.S. job numbers, apparently, and it showed a slowdown in hiring for the prior year. Do you attach much weight? The numbers were too optimistic, it sounds like, or too high. Do you attach much importance to that?
The statistical folks actually do some surveying on really investor expectations for the revisions. The revisions were just marginally larger than expected. There are annual revisions every single year. What this tells us is really what we already know. The labor market wasn't quite as strong over the last year as people thought. We already thought it was weak. This just kind of gives us a better sense of just how weak it was. I don't really attach much meaning to that for the go forward. I think it's extremely interesting to see on kind of a backward looking basis. But what matters on a go forward rate is firm sentiment around hiring, generally hiring expectations, and really what happens in the last couple of months. And that's why I think the Fed is looking at 3 and 6 month moving averages of payroll gains and the unemployment rate for a clearer read on the economy.
Gennadiy, thank you very much indeed. Really appreciate it.
Thanks for having me.
Gennadiy Goldberg, head of U.S. rate strategy at TD Securities.